Hi, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I am here with your Cabot Weekly Review. This is going to be the last one of 2022. I think a lot of us are thinking good riddance to the year, hopefully looking forward to a better market in 2023. So I'm recording this at, just before 9 o'clock a.m. Eastern Time, and as I said, it's on Friday, December 30th. So in terms of the video today, we're going to take a quick look at how the major market indices are doing. We're going to talk about the economy, what to expect in early 2023, and then we're going to talk about three small cap stocks that I think look interesting for the year ahead, including one that has some news potentially coming out next week. But for right now, let's take a look at the S&P 500 index, pretty much exactly where it was a week ago. So the market was closed on Monday, short, low volume holiday trading week. Market is going to be closed again on this coming Monday for the New Year's holiday. So again, trading volume right now, a little bit wonky, a little bit low, so it's kind of hard to read it too accurately. But bottom line is not a lot of movement. As far as the market for today, it's indicated to open lower, but of course we'll just have to see where it goes. So back to the S&P 500, we're down, about 5.5% below where we were in early December, up about 7.5% from the market lows, which were on October 13th. That's probably going to leave the index at about the lower third point of its last 8-month trading range. In terms of the S&P 600, let's swap over to that. Pretty much same picture, about flat over the last week, down about 6% from its early December trading level, and up about 9% from the low on the year, which was hit earlier than that for the S&P 500. Small caps hit their low, I think it was around September 26th here. If all goes about as it's been going this week, then we should see the index finish the year roughly at about the midway point of its last 8-month trading range. The real pain lately has been in the NASDAQ. Mega cap tech stocks have been pretty bad. Definitely bad over the last couple of weeks. So the Nasdaq hit a new closing low on Wednesday, and clearly we would like to see some support here, holding around and above the 10,000 point level. We'll just have to see what happens. Big picture, it's been bonds that have been in the issue lately, as you can see here. Over the last 2 weeks, bond yields have been rising as bond prices have fallen. So the current yield on the 10-year is about 3.8%. That's up from closer to 3.5% a couple of weeks ago. They've been rising for the last 2 weeks since the December 14th FOMC meeting. And on that note, the Fed will be back again on February 1st. Market odds right now are for about a 70% chance of a 25 basis point hike. We could see another 25 basis point hike at the March meeting, but of course the Fed is going to be data dependent, depends on what we see on inflation and employment data that's due out in January and February. Despite the bear market in stocks, and we do have this consensus view that's building around a U.S. recession in the first half of the year, the economy is proving pretty difficult to kill. Just before Christmas, the Atlanta Fed came out. They increased their fourth quarter 2022 GDP estimate by a full percentage point to 3.7%. I think that we're going to be in for much of the same in at least the first quarter of 2023. Kind of a wonky start to the year. Investors are evaluating the incoming data, trying to figure out how much bad news is priced in. We have been seeing the market interpret bad economic indicators as a signal of recession. That's obviously bad for the market. We've also seen the market interpret good economic indicators as a signal that the Fed is going to have to keep tightening until we get a recession. So we have to break that cycle of good news is bad news is bad news in order for the market to act in a much more constructive manner. I think that in order for that to happen, we're just going to have to see inflation come down a little bit quicker than expected. The next big event on that front is the December CPI report, which is going to be coming out on January 12th. Gas prices, used car prices are both down. There are signs that rent inflation has peaked, and prices paid for goods also appear to be dropping. Then we're going to get into the fourth quarter earnings season. That's going to start around the middle of January. We did see management teams, and we heard from management teams, of course, on the Q3 earnings reports. Some of them put out forward guidance. Everybody was being more or less, pretty cautious. analysts have been reducing their earnings outlooks over the last month. So it's just going to be another one of those periods where we're going to have to listen and see what they're saying. And I think there's probably a decent amount of conservatism baked in. It's just a matter of, is that going to be enough? And are we going to get enough data in January to, put the market on firmer footing as we head into the later part of the winter. All right, that's enough on the economy. Let's get into some stocks. As I said, I had 3 small cap stocks that I think look interesting right now. Despite all of the doom and gloom out there, there are some companies that are doing quite well and some stocks that are holding up. So Inspire is one of those. Ticker symbol here is INSP. Market cap of about 7.3 billion. As you can see, the stock has come up here into 253 range. So it's a med tech stock. They have solutions to manage sleep apnea. A lot of recent analyst attention here. So Goldman upgraded the stock recently. KeyBank picked up coverage. Truist Securities has a price target out of 308. They just raised that from 270 a couple of weeks ago. Some building of consensus around a pretty solid obstructive sleep apnea market for the next couple of years, and Inspire is doing a pretty good job of going after that. Management will be presenting at the JP Morgan Healthcare Conference on January 9. The one concern I have with a stock that's doing well like this is we haven't seen a lot of stocks able to break through overhead resistance. So at 253 here, Inspire is bumping up against resistance at 272 from early April. Hopefully we can get through that. I think it's going to take a little bit of a stronger market in order for that to happen, but certainly some encouraging signals here from the stock over the last couple of months. Let's go to the fundamentals table just so you can see what the data is saying. And feel free to pause the video and dig into this, but you can see the annual revenue and earnings trends here as well as the quarterly one. We're just going to highlight the 2022 and 2023 expected results. So this year, assuming fourth quarter earnings come in as expected, revenue should be up around 67%. And then looking forward to 2023, we're looking for around 33% growth. You can see here as well, Inspire is not yet profitable, but they're continuing to invest in growth. And it's really about this revenue line right now that investors are focused on. All right, so that is Inspire. Let's move on to Exponential Fitness. Ticker symbol here is XPOF. Market cap of just about 1.1 billion. So Exponential is the largest franchisor of boutique firms in the US. They have around 2,000 studios across the country. They have must be more than 175 studios now open in 11 or 12 foreign markets. And they've been putting studios on cruise ships as well through partnerships. So they have what you would expect, a full spectrum of verticals. So Pilates, bar, cycling, rowing, dance, yoga, stretching, pretty much everything you would expect. And also acquisitions and partnerships have been part of the growth story here. As you can see, the chart looks pretty solid. The stock has held up very nicely since the Q3 earnings report in early October. We'll go over to the fundamentals just as we did with Inspire. And again, looking at this year, revenue should be up around 55%, and EPS up around 120%. That's kind of a throwaway number because you had a negative EPS line in 2021. But the number here is 12 cents estimated in earnings for 2022. Next year, we get into maybe 17% revenue growth. But again, as I indicated, partnerships and acquisitions are part of the story, and none of that is really factored in. As far as the EPS line, we should see pretty nice leverage on the bottom line as earnings should jump to over $1 next year. So that would be up about 760%. All right, last but not least, let's take a look at Enovix. So this is a somewhat speculative small cap company. Market cap of just under 2 billion. Ticker symbol is ENVX, and they are a battery architecture company. They're developing a 100% silicone anode battery for consumer electronics, mainly wearables right now, and trying to get into electric vehicles down the road potentially. So their technology, they have a whole approach, and it's on their website if you want to go check it out. But bottom line is it's theoretically going to yield a battery that is both safe and energy efficient and also able to charge quickly, which is kind of the holy grail of battery technology. They have completed technical qualifications with a lot of the mega cap consumer electronics companies. We think Apple, Alphabet, Amazon, Tesla, Samsung, and Meta are all in the mix there. Enovix is also working with the U.S. military to build wearable battery cells for soldiers. They don't have any big contracts yet. Hopefully that is what is coming in the year ahead. But right now the big push really is to get manufacturing lines up and running and building commercial quantities in 2023. That's what investors are looking for. And we expect to get an update on that next week. So kind of an interesting setup. A couple of weeks ago, management said they were going to hold a special presentation on Tuesday. That's next Tuesday, January 3 at 2 p.m. Eastern. They didn't say what it was going to be about. Obviously, they're trying to drum up investor interest, but we would think that that should be a talk about where they are with their manufacturing ramp. Maybe get into any interest, strategic investments from a larger company that could help get even more production lines up and running. Ideally we would hear of a large contract, but I'm not really expecting that. I think it's going to be more about where they are with the manufacturing line, and hopefully that's good news. After next week's meeting, management is going to be going and talking at JP Morgan on January 5th and Morgan Stanley on January 5th, and then they move on to Needham on January 11th. So some potential catalysts next week for Enovix. As I said, it's a very speculative company. These clean tech companies tend to be, especially when they're pre-revenue. And Enovix isn't a tiny stock by any means, but at just under 2 billion market cap, it's obviously relatively early stage here. So that's it, guys. That's 3 stocks I think all could be interesting, starting with Enovix next week. Might have some news out. As always, do your own research. Make sure stocks are appropriate for you if you choose to invest. And that's it for 2022. Good riddance to the year. Hopefully next year is better, and we have a much more constructive market in 2023. All right, take care. Happy New Year.